Okay, hello everyone. Welcome to the first IFA Canada event of the new year, which is a joint IFA YIN event involving members from Canada, Austria, and the United Kingdom. I am delighted to welcome and to see that we have a truly international audience today. We have several attendees from the CRA and private practice located throughout Canada, as well as practitioners tuning in from many other countries, including but not limited to China, France, Germany, Ireland, Nigeria, Switzerland, Australia, and the Netherlands. So welcome to you all, and my apologies if I didn't give your country a shout out. This IFA event is focused on the subject of digital services taxes. Let me begin by introducing myself and my fellow speakers for today's seminar. My name is Jennifer Farrell. I work as a professor at the Faculty of Law at Western University in Canada. I teach and research in the fields of income taxation, international tax law, and international trade law, and I will chair and speak at today's seminar. So it's my pleasure to introduce my fellow speakers today. First, Christian Knotzer from Austria, who has researched DSTs during his doctoral studies at the Vienna University of Economics and Business. Christian currently works as an international tax expert for the Austrian Ministry of Finance. Secondly, Hendry from Canada, who worked for the Department of Finance and was involved in the drafting of the Digital Services Tax Act here in Canada. Eric now works as a tax lawyer with Gowling WLG in Toronto, focusing on international tax planning. And thirdly, we have Cristiana Bulbuc, who is a senior associate with the law firm Fieldfisher in London, England. Cristiana focuses her work on direct tax litigation involving high-value corporate tax cases and high-net wealth individuals, and formerly worked for the EU Commission. So I would just like to express my sincere thanks to my fellow speakers for attending today and for all your efforts behind the scenes working on this seminar. I'd also like to extend my thanks to Robin at IFA Canada for her logistical and technical help, and also the IFA branches of Canada, Austria, and the UK for helping to bring us all together today. So next slide, please. So the intention of this seminar is to focus on the legal framework and scope of digital services taxes in each of the three jurisdictions represented today, looking at some similarities and differences from each jurisdiction's experience and addressing some of the challenges and controversies arising from the use of digital service taxes. So we are going to split the seminar into 4 topics, with each of our speakers providing input for each topic. Topic 1 will provide an overview of the framework of the legislation for each jurisdiction. Topic 2 will dive into the in-scope activities covered by each jurisdiction's DST. Topic 3 will look at current and future challenges involving DSTs, and here each speaker will focus on one specific issue of interest to them. And then finally, topic 4 will focus on the current political and trade tensions in relation to DSTs, which is especially topical given the new Trump administration comes into power in the next few days, and also in light of recent leadership changes in Canada. Time permitting, we'll wrap up the seminar by answering any of the audience questions. If you have a question, you can submit it to the Q&A box in your Zoom function, and please ensure you direct the questions to all panelists, otherwise we won't see them. Okay, next slide, please. So before we dive into the topics, I thought it would be prudent to take a step back and spend 10 minutes or so providing a very basic introduction about digital services taxes, focusing on how and why DSTs came about, and the current use of DSTs globally. So, as we are all abundantly aware now, or should be, for the past decade or so, the G20 and OECD has sought to modernize the international tax system, which is outdated, to deal with the realities of 21st century global business and the digital economy. And one of the significant problems deriving from outdated international tax rules is the ability for multinational tech companies to generate revenue in market jurisdictions without ever establishing a physical presence in those markets, and thus avoiding taxation. So BEPS Action 1 sought to address this problem but failed to remedy it. This resulted in market economies, so individual countries adopting their own unilateral DSTs to tax tech companies that generated value within their economies. So what are unilateral DSTs? Well, in short, they are a relatively new fiscal tool for countries to tax the digital economy. DSTs impose a tax on a company's gross revenue generated in a market economy on targeted digital services, and the tax rate that is applied is generally on the low side. There is some debate about how to characterize the DST, but many countries consider it a turnover tax. Now, although DSTs vary in the scope and structure, there are generally 4 characteristics there on the slide that DSTs share. They are a gross tax on revenue, so not net income or profit. They rely on a calculation of national presence. They apply to a range of digital services or activities, such as the use of digital platforms, online advertising, or user data. And they stipulate a revenue threshold. So when the tax kicks in, it only applies when it meets a revenue threshold. And the threshold is usually related to a company's global revenue and the national market revenue. And of note, DSTs apply to gross revenue generated irrespective of whether the digital service involves a payment, so paying a subscription fee to watch Netflix, or the digital service is provided for free, such as using Meta or Google Search, where the value is generated from the user data and advertising. Next slide, please. So in October 21, 136 countries signed up to the OECD's 2-pillar solution statement to seek a multilateral solution to taxing big tech, and this is known as BEPS 2.0. In short, Pillar 1 of the 2-pillar solution featured a new taxing right known as Amount A. Amount A eliminates the physical presence requirement and allocates part of a multinational's residual profits to market jurisdictions, so where the value is created. And this allocation is based on a formula, which we will not dive into today. So the intent was for Pillar 1 to be implemented and for countries to withdraw their unilateral DSTs and transition to a multilateral agreement. But to date, this has not happened. And despite further extensions with respect to Pillar 1, countries continue to implement, maintain, and broaden their unilateral DSTs. So let's quickly look at the current landscape of DSTs around the world. Well, the most recent data I can find is from KPMG and the EU Tax Observatory, which reveals there's been a proliferation of digital services taxes over the past 9 years or so, as well as the introduction of other digital type taxes on the digital economy, such as withholding taxes, streaming taxes, digital PEs, and significant economic presence rules. A KPMG report from December 2024, which is the most recent data, I believe, reports that 35 countries have enacted direct digital taxes. And by my count from that data, 15 countries have specifically enacted DSTs, and several other countries have DSTs that are proposed or currently stalled or paused. Next slide, please. So this table illustrates those 15 countries and countries who have proposed or stalled DSTs. It only lists digital taxes that are specifically or formally labeled digital services taxes. Of note, the DST rates are generally on the low side from 1 to 7.5%. However, just recently, France has announced that it intends to increase its DST rate. Next slide, please. So the EU Tax Observatory data notes that from 2016 to 23, there were 12 active DSTs and 19 countries had proposed or paused DSTs. Now, this data is a little older, but it makes several very interesting observations. First, DSTs exist throughout the world. They are becoming the status quo. You can find them on every continent, either enacted or proposed, and they are applicable to countries at all different stages of economic development. There is a balance of OECD and non-OECD countries implementing DSTs. However, we find DSTs in OECD countries tend to have a higher threshold before the tax kicks in. So they target large tech companies. So the usual suspects, Amazon, Apple, Meta, Google, Netflix, whilst non-OECD countries tend to have lower thresholds. So they are applicable to a broader range of tech companies. The EU Tax Observatory report also notes that a significant amount of revenue has been raised from DSTs. So they are working in terms of a fiscal policy to raise revenue. However, having noted those trends, I wanted to flag some very recent news from Italy. Italy, being an OECD country, has a typical high threshold for its DST, but the 2025 draft Italian budget, and I should stress it's still in a draft stage, has announced that it will drastically extend the DST's reach to non-residents and residents irrespective of their revenue threshold. So effectively what this means is the revenue threshold could be entirely eliminated, meaning any digital business, including small and medium-sized digital businesses, generating revenue from in-scope digital activities will be subject to the Italian DST of 3%. One may speculate that Italy has made this move to avoid economic retaliation from the US, as removing thresholds essentially wipes out the discriminatory nature of its DST. Next slide, please. Okay, so that's enough of me talking for now. Let's move on to topic 1, where each of our speakers will offer a general overview of their country's DST framework. As Austria has the oldest DST, we will start with Christian.
Yes, thank you very much, Jennifer. Good morning, good afternoon, or good evening. Also from my side, thank you for inviting me to speak a bit of the Austrian DST. Now, the Austrian DST is based on the Digitalsteuergesetz, which literally translates to the Digital Tax Act. And it was enacted in October 2019 and is effective from 1st January 2020. So it already celebrates its 5th anniversary this year. It can be regarded as a turnover tax, but from the objective of the tax, it's more like you could say, equalization levy to reflect on what in-scope taxpayers should actually pay in corporate tax. Now, it is an extension of the advertising tax. That is a tax that existed in Austria already since 2000, and this tax was also applies to some forms of advertising services, but it always excluded online services, online advertising services. So revenue targeted or revenue that falls into the scope of this advertising tax is more geared towards adverts in printed media, for example, or adverts in TV or out of home or something like that. On the other hand, the Austrian DST in certain aspects is based on the proposal by the European Commission that would have provided for an EU-wide and a common DST, but which, as you probably know, ultimately failed to reach the necessary unanimity requirement in the Council. But I will come to some EU developments and the EU background later in this webinar today. So when I'm speaking about the Austrian DST, this is, at least as of now, not entirely correct, because the Austrian tax does only apply to online advertising services supplied by online advertising service providers, and not, for example, it does not apply to online intermediation services or the sale of user data or something similar. However, for the sake of simplicity, I will keep referring to the Austrian DST for the remainder of this presentation. Now, the tax rate is a flat tax rate of 5% on the gross remuneration received for the supply of online advertising services. And this is the same tax rate as we can find in the advertising tax. Next slide, please. Now, who are the taxpayers that fall into the scope of the Austrian DST? First, they have to deliver or support online advertising services in Austria, but I will come to what we define as online advertising services in the next part of this webinar. And on the other hand, they have to meet two thresholds. The first threshold is a threshold of 750 million euro on worldwide revenue, and another threshold of 25 million euro of domestic revenue from online advertising services. So in-scope taxpayers have to meet both of these thresholds. And they may be calculated on an M&E group level if the enterprise belongs to such a group. This is different to the advertising tax that we already have, like that we already had since 2000 in our law, which does not apply any kind of thresholds. Now, taxpayers that are within the scope of the digital services tax in Austria, they have substantial record keeping and reporting obligations. The Austrian DST raised approximately 103 million of revenue in 2023, and 2023 then was also the first year where the revenues that were received from the DST exceeded the revenues from the advertising tax. And these 103 million translate to just over 2 billion of taxable remuneration subject to the Austrian DST. With regard to the tax revenue, it might also be mentioned that currently there are negotiations in Austria to form a new government, and as the Austrian budget, desperately needs some money right now. The first task of the new government will be, on the one hand, to cut expenses, but also on the other hand to raise additional tax revenue. And there are rumors right now in the newspapers that also the Austrian DST will be amended. It's not entirely clear in which direction the amendments will go. So either they will extend the scope, so maybe they will extend the scope to other services despite advertising services as well, or maybe they will increase the rate. It's not clear as of now, but maybe there will be some amendments in the upcoming months once we have a new government. And maybe then the Austrian DST will indeed be also a true DST and not a digital advertising tax. With that, I would like to hand over to Cristiana for the UK perspective. Thank you very much.
Thank you, Christian. The UK DST, the legislation is contained in Part 2 and Schedule 8 to 10 of the Finance Act 2020. and applies to turnover of certain digitalized businesses from the 1st of April 2020 until it is repealed. The UK DST was implemented as a temporary measure as well until a global solution is reached. And the Labour government has stated that it is committed to disapplying the DST once an appropriate international solution is found. The legislation does not provide for automatic repeal on a specific date. Instead, the Treasury is required to conduct a review and prepare a report to be laid before the Parliament by the end of this year. In respect of the threshold nexus, HMRC administers DST at the level of business group rather than individual companies. The group are liable to pay DST if their worldwide revenue from these digital activities, which we'll discuss later, are more than £500 million, and if more than 25 million of revenue is derived, and this is the key, from UK users. If the group exceeds these thresholds, their revenue and not profits derived from UK users are taxed at a rate of 2%. Next slide, please. The UK DST has shown notable effectiveness in its initial years. In the first year, 2020 to 2021, the DST was shown to have raised around 358 million pounds, which was 30% more than initially forecasted. This higher than expected revenue was partially due to the unpredictable impact of COVID, but also because HMRC's original estimate of DST revenue was adjusted downwards by 20% in the expectation that some business groups would take legal measures to reduce or remove their requirement to pay DST. However, this was not identified by HMRC. In addition, the reason why the forecast was lower than what they actually got was because more businesses came into scope of the legislation than previously expected. By 2024-2025, the DST is projected to raise in excess of £3 billion. The National Audit Office's investigation of 2022 shows that around 90% of the DST revenue paid for in its first year, 2020-2021, were provided by 5 business groups, reportedly Amazon, Google, Apple, and eBay. For the UK, the aim of the UK DST, like for Austria, is for businesses that have no UK presence but generate value in the UK from UK users, should effectively pay their fair share, and thus addressing any misalignment between where profits are taxed and where value is created. And the government is adamant to ensure that this will continue to be so. I will pass on to Eric. Thank you.
Thanks so much, Cristiana, and thank you, Jennifer and Aoife, for the invitation to talk about Canada's DST. So Canada's DST is a relative newcomer compared to other countries, having only recently come into force in June 28th of 2024. It's pretty standard at a structural level in terms of DSTs, in the sense that it's a tax on in-scope gross revenue with a connection to Canada. It's taxed at a rate of 3%. It applies to all businesses, including Canadian residents, so residents and non-residents could be caught by it. There are 2 thresholds that businesses have to meet in order to fall within the scope of the DST. The first is a global revenue threshold of 750 million euros. So that's the same as Austria's DST that Christian mentioned, and also France's DST. It's also the same as the OECD's country-by-country reporting threshold, for those of you familiar with that. And there's also a a group revenue threshold for in-scope revenue. So revenue that falls within the scope of the digital services tax of 20 million Canadian dollars. And that's also on a group-wide basis. So I'll talk a little bit about the procedural history, if you will, of kind of how the DST came into being in Canada. And in spite of its kind of relative youth, it's had kind of a colorful history, at least from that standpoint. It was announced in Budget 2021, and its policy logic is kind of generally consistent with those of other DSTs. The Canadian government, when it was announced, expressed a desire for the tax system to account for digital businesses that can basically create value by engaging with users remotely, users in Canada remotely, without having a permanent establishment in Canada. Basically, the DST in Canada was always kind of a second, backup option to Pillar 1, which the Canadian government always maintained was its first choice. So it's always expressed a preference for a multilateral solution to this problem. But the DST was kind of brought in as a backup, right? And so that's kind of how it started, and draft legislation was originally released in December 2021 with the DST intended to apply to in-scope revenue earned as of January 1st, 2022. But the Canadian government at that time had agreed to a temporary moratorium on unilateral DSTs to allow progress on the OECD G20 Inclusive Frameworks Pillar 1 initiative, which again was its preference. And so it announced that the DST would not come into force unless an agreement on Pillar 1 was reached by the end of 2023. And so that was 2 years away at the time, which seemed like a long time for Pillar 1 to progress enough to avoid a Canadian unilateral DST. But time flies, and in late 2023, it became clear that Pillar 1 was not going to meet that deadline. So a lot of countries signed on to a further extension on the moratorium for unilateral DSTs. Canada did not. Canada expressed a desire at the time to begin collecting DST and move forward with its DST. So legislation was passed through Parliament, and ultimately the DST was brought into force by an order in council, as I mentioned, in kind of mid 2024. And I should also mention that it applies in the 2024 year, its first year of application. It applies retrospectively to in-scope revenues earned in 2022, 2023, and 2024. So a lot of people have characterized this as kind of retroactivity, and we'll talk a little bit about the implications of that later on. But for taxpayers, at least, the 2024 year is going to be kind of a large tax bill in the sense that it takes into account digital services revenue for those 3 years. In terms of revenue, just very briefly, obviously none has been collected yet. It was estimated originally in 2021 by the Canadian government that it would raise $3.4 billion over 5 years. More recently, the PBO, the Parliamentary Budget Officer, is kind of semi-independent in Canada, estimated that the DST would raise around $7.4 billion over 5 years, so a little bit higher. So I'll throw it back to Jennifer to discuss topic 2.
Okay, thank you, Eric. Next slide, please. So we'll dive straight into topic 2 and look in more detail at the in-scope activities that are covered by DSTs. And again, we'll start with our youngest DST, which is Austria. So over to you, Cristiana.
Yes, thank you very much. As I already mentioned before, the Austrian DST, at least in its current version, only applies to online advertising services. Now, what are online advertising services? Those are defined in the law as adverts displayed on a digital interface, and the law mentions that especially banners and search engine adverts, but also comparable forms of adverts should be covered by the tax. The law itself gives the Austrian finance minister the possibility to determine what should be understood as a comparable advertising service by way of an ordinance, but and the reason for this is to be able to swiftly react to new forms of adverts. But so far there has not been any ordinance to that respect. For advertising services to be covered, they have to be provided on a digital interface. We know this term already from the DST directive proposed by the Commission, which should be understood as any kind of software that users can access. So the most notable examples, of course, are websites and apps. Now, for an online advertising service to fall into the scope of the tax in Austria, it has to have some kind of an Austrian nexus. And this nexus is defined by two criteria that both must be fulfilled in order to fall into the scope of the tax. First, the online advertising service has to be regarded to be supplied within Austria if it is received on a device of a user with a domestic IP address. This criterion was chosen to present an easily identifiable proxy for the location of the user. The device can be anything from a computer to a mobile phone, a smartwatch, gaming devices, TVs, and so on and so forth, you name it. However, it needs to be mentioned that other methods of geolocalization can be used as well besides the IP address, as long as those methods identify the location of the user. It is sufficient that the link or the advert appears on the device of the user. It is not necessary that the user in any kind takes note of the link or even interacts with the advert or anything with a similar effect. However, of course, when the remuneration is to be paid by the advertising company to the advertising service provider, when this remuneration is dependent on some kind of interaction, of course, of the user with the advert, for example, pay-per-click arrangements or something similar, then there would, of course, only be tax due if there is an actual remuneration. The second criterion is that there must be a specific connection to Austria with regard to the content and the design of the advert. So the explanatory notes to the law that implemented the Digital Tax Act in 2019 mentioned the example of a banner that is addressed to an Austrian audience on a website of a foreign newspaper. This would be an example of a specific connection to Austria. But that also means, of course, adverts not specifically targeted to Austrian users do not fall within the scope of the Austrian DST because they do not qualify as an online advertising service in Austria. That's all from my side, and I would like to again hand over to Cristiana for the UK perspective.
Thank you again, Christian. Now, what is DST payable on? DST, UK DST is not payable on the online sale of goods, nor is it taxed on the provision of online content, such as TV or music subscription services. The provision of finance or payment services are also outside the scope of the DST, UK DST. Services within the scope of the UK DST are those which monetize UK users' engagement with 3 online platforms. In other words, revenues attributable to UK users from 3 digital service activities, which include social media platforms, online marketplaces, and search engines. Now, the definitions are pretty broad. There has been some confusion as to who might fall within the scope. And HMRC is engaging with various companies in this regard, among other things. Now, after the group amount of DST is determined, this is allocated between the group members, each referred to as a relevant person, by reference to the proportion of UK digital services revenues attributable to each relevant person. While calculating a group level, while DST is calculated at the group level, The DST is a tax that is levied on individual group entities and not the group as a whole. There are certain reliefs. One of them is group first 25 million of UK revenue are exempt from DST. Can move to the second slide, please. There is also a safe harbor in UK DST. So this came about because of concerns on the impact of DST on businesses in low position or businesses with very low profit margins. And this is addressed through the safe harbor, which allows such companies to elect an alternative tax calculation. As a result, the qualifying business in a loss position will not have to pay the DST, and those with low margins will have to pay the DST at somewhat reduced rate of tax. The alternative basis of charge is available on an accounting by accounting basis, and an election is made against a specific category of digital service revenues, i.e. either social media, internet search engines, or online marketplaces, meaning that if a business has 2 or more types of in-scope digital activities, it could choose to apply the alternative basis of charge to one, both, or neither of them. In respect of the interaction with UK corporation tax and other digital service taxes, the DST will not be credited against UK corporate income tax liability, but like any other expense, DST may be deductible for a company as an allowable expense against UK corporation tax subject to the normal rules. In particular, the DST expense must be incurred wholly and exclusively for the purpose of the relevant company's trade. There's a lot of case law on this, what this actually means, and a lot of litigation, which possibly will emerge in respect of the DST later on. Therefore, groups, there is a problem here because groups which are not subject to DST, which are subject to DST but not have a UK corporate paying entities, will be generally unable to benefit from this deduction. No credit relief is given either for DST against corporation tax or any other taxes. However, there's a 50% relief, which will be given on certain cross-border transactions. These are transactions on an online marketplace provided by the group where a foreign user is party to the transaction and all of or part of the revenue of the group is in connection with the transactions are subject to a foreign digital service tax similar to that of the UK, and this is key similarity. The 50% relief works by disregarding 50% of any UK digital services revenues arising to the group in connection with any relevant cross-border transaction. Now, countries that have taxes that are considered to be similar to UK DST for cross-border relief purposes are only 5 on HMRC's website, which are France, Italy, Spain, Turkey, and Canada. Interestingly, Austria is not listed, and therefore such relief is not available for companies that paid Austrian DST. This means that companies can be subject to DST in both Austria and UK without any offset, which will increase their tax burden for businesses. In respect of Canada, which has a retrospective legislation, groups who are impacted can submit amendments to their DST return to claim additional cross-border relief. And for those who are or might be out of time to submit any amendments, the responsible member may make a claim for overpaid tax under certain Finance Act 2020 provisions. Due to double application of various countries' DSTs, or in certain cases triple, there might be in the future double taxation, increased compliance costs, of course, distortion of business decisions, trade tension, and complexities in profit attributions later on that might lead to litigation. I will hand over to Eric now. Thank you.
Thanks so much, Cristiana. So I'm going to be talking a little bit about the scope of Canada's DST. And I think just at the outset, it's really interesting hearing from an Austrian and UK perspective, because I think Canada has a lot of similarities. But I think generally speaking, Canada's DST with respect to its scope is a little bit broader. I think it's most similar to the French DST in terms of its scope. But it's a little bit broader, generally speaking, than the UK and the Austrian DSTs. So I'll kind of get into the details a little bit at a high level. So the DST in Canada applies to 4 revenue streams: online marketplace revenue, online advertising revenue, social media services revenue, and user data revenue. Each to the extent of the connection of that item of revenue with Canadian users, generally speaking. So I'll talk a little bit about each one and kind of what types of revenue would fall into the scope of each kind of revenue category that the DST applies to. So the first is online marketplace revenue. Online marketplace revenue is generally you're talking about services that are provided through an online marketplace that helps match sellers of goods and services with potential buyers. So it isn't the sale of goods itself, it's the intermediation function that's being caught here, and it's revenue attributable to that intermediation function, right? Where your marketplace is connecting a buyer and seller. And so what would be included as well, in addition to that, is kind of premium services that enhance the basic intermediation function. And it would also apply to, let's say, commissions, right? For facilitating the supply of goods or services on the online marketplace. There's some exceptions, notably financial services. So consistent with other DSTs, financial services are carved out of online marketplace revenue. And also importantly, as I mentioned, the sale of goods and services by a seller on its own account is not subject to DST as online marketplace revenue. However, if you have, let's say, a traditional retailer that is, selling its own goods online, but is also on that same kind of online platform facilitating the sale of third-party goods and earning revenue from that, from facilitating that is DSTable to the extent of the facilitation. So online advertising revenue. So this is applies to services that are aimed at the placing of online targeted ads. And targeting is defined very, very broadly. And it's targeting based on user data gathered from users of an online interface. And it can include geographic targeting, demographic targeting. So that's defined very broadly. And a little bit unlike the UK DST, which I understand only applies to search engine revenue. This would apply to online interfaces like online marketplaces, social media platforms, any kind of online targeted ad that's being directed at Canadian users, generally speaking. And it also applies, importantly, to activities that facilitate the delivery of the online targeted ad or that supply digital space to it. So, you think of a lot of advertising kind of intermediation companies that are doing the placing of the ad. That revenue is caught, and then also supplying that space on your website, right? That's receiving a lot of traffic. Revenue from supplying that space to, let's say, an advertising company that's facilitating it. That revenue is caught as well. Social media services revenue. So this applies to services provided through an online interface whose main purpose is to facilitate interaction between users. So not just an ancillary purpose, it has to be the main purpose for it to be a social media platform under Canada's DST. It generally appears to be targeted at kind of premium user fees or fees that are earned or collected to access the social media platform. So when you think of most social media companies, I think a lot of their revenue is coming from targeted ad revenue. So that's not going to be caught under this category. It may be caught under advertising revenue. but social media revenue is more about kind of fees for accessing the social media platform. User data revenue is the final category. So that's the sale or licensing of data gathered from users of user data. User data is defined very broadly. But the kind of tricky part here that really narrows the scope of this category is the user data has to be collected by the taxpayer or member of its group from an online marketplace, social media platform, or online search engine, as defined in the legislation. So it's not just any monetization of user data. It's from very specific sources. The user data has to be collected. And again, it's only taxable to the extent of its nexus with Canada, any item of revenue. Typically, this means the extent to which the item of revenue is connected to a user located in Canada. Again, it's defined in the legislation. Although for an online marketplace, it can also mean, the supply takes place in Canada, basically, regardless of where the users are located, or it involves the supply of, let's say, real property in Canada. I should also mention that it's deductible against Canadian corporate income tax under ordinary principles. So it's not creditable, but it is deductible from Canadian corporate income tax under ordinary principles. And finally, just to wrap up, there is a $20 million deduction that's shared among the related group that basically reflects the amount of digital services revenue you earned below the domestic in-scope revenue threshold. And also, there's no safe harbor for low margin businesses like with the UK DST. So with that, I'll throw it back to Jennifer.
Okay, thanks so much, Eric. So we're going to move straight into topic 3 and look at some current and future challenges and controversies surrounding DSTs. Here, each of our 3 speakers are going to look at different themes. Cristian will start talking about DSTs from a European Union perspective and the prospect of an EU-wide DST proposal. Cristiana will then look at DSTs in relation to tax treaties and litigation. And finally, Eric will look at some compliance issues. So over to you, Cristian.
Yes, thank you very much. Now, as Austria among the countries that are represented in this webinar today is the only country left in the European Union, I would also like to address the EU perspective. So as already mentioned earlier, there is no harmonized DST in the EU as of now. However, still the EU perspective is interesting, both if you look into past proposals and also if you look a bit into the future. So in March 2018, the Commission introduced its digital taxation package. That included 2 legislative proposals for a common EU approach. The first is a proposal for a significant digital presence, and the second, a proposal for a DST. Now, the SDP, the Significant Digital Presence proposal, was seen as the long-term solution. Companies would be deemed to have an SDP in a member state where they fulfill one of the following requirements. So either they have revenues from supplying digital services in that member state exceeding 7 million euros, the number of users in a member state exceeds 100,000, or the number of online business contracts exceeds 3,000. And the profits attributable to such a SDP, or you could also name it digital PE, would have been determined based on TP principles, however, with some modifications to take account of the different nature that digital PEs have compared to traditional PEs. Now, on the other hand, we have the DST proposal, and this was, in contrast to the SDP proposal, designed to be an interim solution only. Indeed, it was the Austrian presidency of the Council that in the second half of the year of 2018 tried to push the DST and get the approval of all other member states. Taxable events would have been online advertising, making available digital platforms that facilitate interactions between users, and the sale of collected user data. And the revenue from such services would have been taxed at a rate of 3%. Furthermore, it would also have included thresholds, so only businesses with a total revenue of above 750 million and a revenue from digital activities within the European Union and covered by the directive above 50 million. You can see that this is quite a similar approach that was in the end taken also by Austria. In the end, this proposal was supported by a majority of member states, but not by all. And since unanimity is required to pass an EU directive in the field of taxation, the DST directive did not materialize. So as this proposal did not get the approval by all member states, there then was a last attempt to save the DST directive to a certain extent for a narrower proposal, which only focused on digital advertising services and which also included a sunset clause referring to developments of the OECD. However, also this proposal in the end was not adopted, and in March 2019, you could say all proposals were denied. And thereafter, as we know, many European countries introduced DSTs unilaterally. However, a common EU-wide approach with regard to the tax challenges of the digital economy is still not off the table. The Commission, in the midst of the COVID-19 pandemic, announced another legislative proposal for a digital levy. However, so far there have not been any detailed proposals what this digital levy should be and how this digital levy would be different from a DST, apart from some very general policy options that were released in a preliminary impact assessment to be found on the Commission's website. This plan was included in the Commission work plan in 2021 and mentioned in some official documents thereafter, but now at the moment is put on hold in light of Pillar 1 developments. However, it seems very likely that discussions will be revived also at the level of the European Union again when the MLC to implement Amount A of Pillar 1 fails, which at least does not seem to be an unlikely outcome at the moment, to put it mildly. With that, I would like to give the floor to Cristiana again.
Thank you again, Christian. I'm a tax litigator, and therefore I'm very happy to discuss the possible litigation issues that could stem from UK DST application by reference to tax treaties, WTO, domestic litigation, and possible international arbitration under bilateral investment treaties, IIAs, and free-trade agreements, and difficulties for companies, groups, and HMRC to pursue such litigation. When it comes to double tax treaties, the UK government's view is that DST is compatible with the UK double tax treaties because it's imposed on revenues from certain digital business activities, irrespective of where the company recognizing those revenues is resident, where the company's group, its parent, and its parent is located, and where the activities of the group leading to the generation of revenue are undertaken. Therefore, it does not discriminate against non-resident businesses. Also, the UK government's view is that the tax is not an income tax, that the business profit or other income articles in the UK's double tax treaties preclude the UK from imposing on non-residents. It says that the UK tax does not qualify as a tax on income, as broadly speaking, income refers to net income, despite the fact that the legislation includes safe harbors and the 25 million relief. However, if you look at it carefully, it can be argued that both the UK and, for example, the US treaty and the OECD US treaty and the OECD model apply not only to taxes on net income, but to taxes on total income or elements thereof. Therefore, it may well breach both double tax treaties and international trade law. Unlike the normal charge to corporation tax on income, the UK DST can apply to a taxpayer that is neither UK resident nor has a UK permanent establishment. If you think about it, both Article 2 and 7 of the UK-US, for example, double tax treaty appear to actually prohibit the UK DST from being charged on a US entity with no UKP connection. MAP procedures could be commenced. However, for DTTs without an arbitration provision, after 2 years of no agreement being reached between the two tax authorities, the case could be protracted indefinitely. For those with arbitration provisions, after 2 years, arbitration can be commenced. However, it can last long and it is costly. Now, for WTO discussion, double tax treaties, as I said, are one option. The WTO, the international trade law of WTO rules also could apply. There is a consensus that digital services are covered by the GATT sectors, and the UK is prima facie prohibited from providing less favorable treatments to or discriminate against service providers from other WTO members. The legislation appears to, at first glance, and can be argued to appear to arbitrarily target US tech companies, and the revenue threshold seems to cover few UK EU groups. However, WTO legal mechanism for challenging UK DST is unlikely to be very effective remedy due to it being a state-to-state mechanism. Thus, political climate plays a very big role in determining if such proceedings should commence. It takes, at best, 3 to 5 years to complete, and it's extremely complicated. If you could move on to the next slide. The other option is to commence domestic proceedings against HMRC or vice versa. HMRC is in the process at the moment of identifying non-compliance. It is not clear whether all business groups have been captured that should be within the scope of the tax. HMRC could still face challenges ahead in enforcing compliance, especially among groups without physical presence in the UK. HMRC has identified more business groups that potentially fall within the scope of DST than it initially expected. Just by example, in July 2018, before the legislation was implemented, it had considered only 31 businesses for being potentially in scope, but by September 2022, that number increased to 101. Any businesses found to be liable will be retrospectively assessed for 2020-21 tax years and so on. At the present moment, according to the National Audit Office analysis of 2022, HMRC are still engaged with 46 groups of companies covering 104 online services that might potentially be investigated either for failing to submit DST returns, whether they fall within the scope of the legislation, the quantum of the tax liability. However, in my opinion, given there is no solution to Pillar 1, multinational enterprises will try to protect the commencement of any litigation and pass on the cost to consumers in the meantime. And I cannot see that anything will start before courts before 2028, 2030. There are many difficulties in respect of jurisdictional issues, legal grounds, political and diplomatic considerations, identifying liable companies and compliance to commence proceedings by either HMRC or companies against HMRC. But we don't have time to talk about those at the moment. If anybody has a question about that, I'm happy to answer them. Thank you. I'm passing on to Eric now. Thank you.
Thanks so much, Cristiana. So when we're talking about kind of challenges in the context of the Canadian DST, I think it's impossible to ignore kind of the elephant in the room here. And in my case, and I'm in Toronto, the elephant on the other side of Lake Ontario. And there's basically two kind of as I see it, existential threats or challenges to the DST right now. And number one is the U.S.-Canada trade relationship that Jennifer will touch on in the next section. And also, as I'm sure most people are aware, Canada's domestic political turnover that has seen kind of the two biggest champions of Canada's DST in Chrystia Freeland and Justin Trudeau announce their resignation. So we'll touch a little bit on the impact that that'll have, but it behooves me to at least mention it when we're talking about the challenges in the context of the Canadian DST. In terms of normal challenges, if you want to call it that, I think the central challenge for taxpayers, especially in this climate of kind of political uncertainty, is compliance. When you think about the DST from a taxpayer's perspective, you have a novel legislative scheme that basically has this kind of retrospective aspect to it, and you're having to basically assess all of your revenue streams and build compliance systems to ensure that you are paying the correct amount of DST. So you're having to go through the legislation and assess what's in scope, what's not in scope. And you're having to do this in the absence of judicial guidance on what those novel terms mean. And there's explanatory notes, I think pretty good ones, that the Department of Finance released, but that only goes so far, right? So it's pretty challenging. Now, one of the things that's kind of interesting about Canada's DST, given its kind of retrospective aspect in the first year of application, is the government introduced an election that taxpayers can make in their first year, where they can basically treat their revenue from 2022 and 2023 as being the same as it was in 2024. So there's obviously a lot of uncertainty as to whether the Canadian DST would ever be enacted when draft legislation was first introduced. So I thought this was kind of a sensible measure that the Canadian government took, right, to kind of say to taxpayers, look, if you want, it's an election, you can calculate your 2022 and 2023 revenues as being the same as they were in 2024. So that's hopefully going to help ease the compliance burden a little bit. But again, there's still a kind of overriding climate of uncertainty, I think it's fair to say, with respect to Canada's DST. So I'll throw it back to Jennifer for the next topic.
Okay, thanks everyone. So our final topic concerns probably the most topical and important issue at the moment, which is political tensions and trade tensions. We don't have any slides for this topic. We thought we'd just all put ourselves on the screen and have a talk. So I'll just start by giving you a little background to the trade tensions in relation to DSTs. Obviously, trade tensions hinge with the United States, which is the home to some of the world's largest tech digital service providers. The US has consistently pushed back against multilateral attempts to tax the digital economy. And this is based on the justification that proposed multilateral tax rules target US tech giants by placing them at a competitive disadvantage, and the reallocation rules result in a loss of revenue for the United States. So the US has objected to both Action 1 of the BEPS and more recently Pillar 1, which was first found no support under the Trump administration, and despite some flexibility under the Biden administration, also did not result in any success. So the US has also launched a series of trade complaints against individual countries concerning their unilateral DSTs, claiming DSTs violate international trade obligations because they are designed to target US companies. The US Trade Representative first challenged DSTs in 2019 with a complaint against France under Section 301 of US trade law. And Section 301 essentially grants the US power to engage in trade wars with countries that have discriminatory policies. So the USTR found, with respect to the French investigation, that France's DST was unreasonable and discriminatory and specifically burdensome for US companies. And based on this decision, the US proposed a 100% tariff on various French products, and those tariffs approximated to the amount that France was collecting with its DST. We then saw further investigations being mounted against Austria, India, Italy, Spain, France, Turkey, and the US. But tariffs against these countries have been permanently suspended since November 2021 under the Biden administration to allow countries time to reach a political agreement on the Pillar 2 solution. So I'm going to hand over to Cristian to talk a little more about the permanent suspension of tariffs and the conditions attached to that suspension. Austria has committed to removing its DST, but with the implementation of Amount A now being highly unlikely, Cristian, how do you see the future of the Austrian DST panning out?
Yes, thank you very much. So from the beginning on the works of BEPS and what should later become the two-pillar solution, Austria was very dedicated finding a multilateral solution at the level of the OECD and still is. Also, the Austrian Digital Tax Act includes a sunset clause in light of broader developments at the level of the OECD. And furthermore, as you just mentioned, the Austrian DST is an existing measure that is mentioned in the Amount A MLC draft, subject to removal once Pillar 1 Amount A enters into force. Now, as it has become clear that consensus on Amount A would require some more work and therefore some more time, Austria decided to introduce a tax unilaterally, which in turn, as you mentioned, led to Section 301 investigations by the US in summer 2020. And the opinion back then was that the DST would discriminate against US-based digital firms, and some punitive tariffs on Austrian products were on the table. Now, this tension led to a unilateral measures compromise between the United States on the one hand and Austria, France, Italy, Spain, and the United Kingdom on a transitional approach before Pillar 1 is in effect on the other side. This was released just a few weeks after the October 2021 statement of the inclusive framework, and later was updated to extend the end date. This political compromise, in essence, provides that on the one hand, Austria and the other countries I just mentioned is allowed to continue to apply its DST, but would credit a certain excess amount of such taxes against future Amount A tax liability of the companies concerned. The idea of this compromise would be that in the interim period, so until Pillar 1 comes into effect, the countries mentioned only apply their DST insofar as it corresponds to a fictitious Amount A tax liability. However, as it's expected that, at least for Austria, that the Amount A tax revenue that would be collectible once Amount A comes into force is higher than what is currently generated under the DST, it might be even the case that there will be no need to credit any taxes against Amount A tax liability. And on the other hand, the US has to terminate its Section 301 trade actions. Now, as you said, an agreement on Pillar 1 is rather uncertain as of now, and I would expect that if this is admitted in the future, then the EU, as I said, will revive its plans for a digital services tax or some similar action. And this will then, of course, as a member of the European Union, also affect the Austrian DST. However, in that context, I think we should not forget that the termination of the Section 301 investigations and the retaliatory measures were contingent on the removal of DSTs when Pillar 1 takes effect. So if the DSTs are finally here to stay, one might expect that such trade actions will be taken up again. So under all these circumstances and all these intertwined developments, it is hard for me to tell as of now what the future of the DST will be. Thank you.
Thanks, Christian. And as Christian pointed out earlier on, Austria is indeed the only EU country present today. And with that in mind, maybe I can ask Christiana how you feel the DST in the UK will pan out. Do you have similar thoughts to Christian?
Okay, I'm muted. Yes, in a way. So in UK's case, under the agreement, UK is obliged to credit DST payments if it will be ever implemented. The Labour government has indicated that it does not plan to repeal the DST immediately. And instead, like Austria, the UK remains committed to reaching a global solution on the digital taxation of digital economy. The intention is to repeal DST once the international solution is reached. And Labour has also confirmed that it has no plans to raise the DST, emphasizing that it was always intended to be a temporary measure. However, if Pillar 2 Amount A is further delayed, because I personally don't believe it will totally be dead, like CCCTB, it was rebranded after circa 10 years and BIFID was proposed. I think probable rebranding of the Pillar 1 and Amount A will be reached at some point. And I think at the moment, and this is my personal opinion, I think UK will wait for 4 years before it does anything, just for Trump administration to end in 4 years' time. And in the meantime, I think given the amount of revenue that they receive, they are happy to invest or spend 0.5 to 2%. So between, I don't know, 15 to 30 million pounds or 60 million pounds to collect to spend on legal fees to be able to continue to collect the amount of revenue that this tax generates for the government. And in the meantime, companies will just wait and see and pass on the costs to their customers. That's my view.
Okay, thank you, Christiana. I guess we disagree a little on the future fate of Pillar 1. You are more of a glass half full person, I guess. So let's move on to Canada's position, which is very important at the moment. Just to give you a little background of where we are with respect to Canada. In July of 2023, 138 of the 145 members of the Inclusive Framework agreed to hold off imposing DSTs until at least 2025 now to allow for additional negotiations. Canada objected to this. It did not support the DST moratorium without a firm and binding timeline for implementation. And thus, as Eric has explained, the Canadian DST has gone ahead and was implemented in 2024. So it's of no surprise that we find in August of 2024, the US Trade Representative has announced a formal challenge against Canada's DST. And this is under the dispute settlement provisions of the Canada-US-Mexico Agreement. So this is known from a Canada perspective as CUSMA or the new NAFTA. I will call it CUSMA for now. So CUSMA obliges members to grant suppliers and investors from fellow member states with no less favorable treatment in like circumstances to that of domestic suppliers and investors. So in other words, what we have here is a non-discrimination obligation. The US Trade Representative is arguing that the Canadian DST targets and discriminates against US companies and essentially breaches Chapter 15 and Chapter 14 of CUSMA concerning trade and services and investment. So this puts Canada in a uniquely precarious position at the moment, and the stakes are high. There is an active CUSMA complaint against Canada at the moment. We will see how that pans out with the new Trump administration. The US is Canada's leading trading partner. Trump has already threatened tariffs of 25% against Canada, although those threats have been directed against security, illegal drug flows, and migration issues. And it is unclear that if Trump will engage in any negotiations concerning Pillar 1 and the global tax deal. I am on the pessimistic side that he will not. And it's highly unlikely, therefore, that US lawmakers will ratify the multilateral agreement or treaty on Pillar 1. So in the next few days, the Trump administration will begin. And this raises the fundamental question, what happens next with respect to Canada's DST? And I'm going to hand over here to Eric to ask, with Canada in this unprecedented, uncertain position, how do you see the DST panning out? And just to emphasize, Canada has never pulled a tax at the behest of the United States. But in light of the threat of tariffs and the current political situation that you alluded to with respect to the resignations of Trudeau and Freeland, what does the future hold?
Yeah, thanks, Jennifer. And, you know, taking off my kind of tax lawyer hat for a moment and putting on my kind of more colorful political pundit hat, if you will, you know, it's difficult for me to see the DST being pulled before a Canadian election. And a Canadian election, I think, is anticipated to happen or must happen at some point in the coming year, probably even sooner than by the end of the year. It's hard for me to see it surviving long term after an election. And there's kind of a number of factors kind of working against the DST's long-term survival in Canada. You know, it's kind of unloved as a statute, right? As a tax. It was the government's kind of second best option all along, compared to Pillar 1, right? Taxpayers and businesses hate it. Its two biggest political champions have now resigned. And also the public doesn't, in my view anyways, just doesn't seem to know or care kind of what the DST is in Canada. Anytime I kind of talk to people about it or read media coverage about it, it's, you know, it's referred to as the Netflix tax, which is not. So that's this kind of a separate sales tax measure in Canada. But I don't think people appreciate kind of really what it is and what it's doing and what it applies to. So that makes it kind of, you know, politically expendable in that sense. And then also, you know, it's also associated with, I think it's, you know, fair to say, a deeply unpopular federal government in Canada, and it has the word tax in it. And so the Conservatives are way up in the polls right now. They're kind of anticipated to be the next government, at least if an election were held today. And I suspect that they would see the DST as another kind of tax to axe, so to speak, if they get in. And then obviously, as you spoke about, Jennifer, there's the trade reality that comes with an incoming Trump administration that's aggressively protectionist. That's going to mean negotiations, almost certainly, as it did with you know, renegotiating NAFTA during Trump's first term. You know, I saw an interview with Vic Fedeli, Ontario's trade minister, where he talked about meetings he had with U.S. officials about the trade relationship, and he mentioned that, you know, item 1 on every meeting he had was the DST. And these are generally kind of Biden administration officials, right? So there's kind of a bipartisan consensus that the U.S. Absolutely hates the DST in Canada. So it's interesting though, because in negotiations, I can see the DST playing a role where it's an arrow in Canada's quiver, so to speak. It's a card that Canada can play by conceding, somewhat on the DST, either by repealing it or by reducing the rate or the scope or something. It allows the U.S. to drop tariffs. So I think that kind of works against its long-term survival. And where does that leave us? Unfortunately, it's kind of it's already almost embarrassing that we're still talking about this problem of how to tax the digital economy. I mean, the economy's been digitized since for well over 20 years now, and it may lead us back to square one. Not to heap on the pessimism here. I think we've had a lot of it, and I'm grateful Cristiana kind of injected some optimism, at least, into our discussion. But I'm not super optimistic here that the DST will survive very long. And again, that's purely speculative, but we'll see.
Okay, thanks so much, Eric. So I think what we can conclude there from a trade and a political context is we're in the middle of a lot of uncertainty for all countries operating DSTs, but especially so for Canada. And it is very much a case of watch this space for the moment to see how things unfold in the coming months as the new Trump administration takes power. So we have about 7 minutes remaining for any questions. I see one question here about the incidence of DSTs, where the burden of the incidence of DSTs lie. I can say something briefly about that, and perhaps someone else can chip in. I think the incidence is generally unknown, at least from a research-based perspective. I have not come across much empirical evidence or investigations about the incidence of DST, but we can safely say that tech firms have repeatedly said that they will pass on the burden of the DST to their consumers. And we can see that in black and white with Google. If you go to Google's page with respect to DSTs, they have a whole list of jurisdiction-specific surcharges. I can't speak for other countries, but I know that Google is adding 2.5% as a DST fee on its invoices for advertised services in Canada. And they specifically say this is to cover the cost of complying with Canada's new DST legislation. Does anyone else have any thoughts on the incidence issue?
The same for us. The NAO in the UK have confirmed that Amazon said that Amazon, Google, and Apple have said that they will pass on the cost of the tax to their customers, which is not great, but we'll.
Okay, and finally, just very quickly, within about 3 minutes, we have a question which is asking, given the problems with DSTs, is there any alternatives on the table? I've actually recently been reading about this, and I would highlight two interesting reads. One by Reuven Aviona and Christine Kim from a US perspective, who discuss alternatives to DSTs in a new book called International Tax Revolution. And there's also an excellent editorial in Intertax called Plan B by Philip Baker, who talks about adopting a Plan B, essentially, with respect to DSTs, based on general principles in the absence of Pillar 1 success. Christian, I think you had some thoughts about alternatives that you'd like to talk about.
Yeah, maybe I can jump in here and bring up some developments which I think are essential to any webinar that deals with international tax in these times, which are developments at the level of the UN, which I think we cannot ignore. On the one hand, maybe less relevant, but still the work of the UN Tax Committee. The UN Tax Committee proposed, which some would argue is an alternative approach to Pillar 1, Amount A, which is their bilateral solution, let's call it that way, Article 12b in the UN Model Convention, where some authors are of the opinion that this would be a provision that would to some extent solve the inconsistencies of DSTs with double tax treaties, because they would somehow try to find a distributive rule for automated digital services. So this might be also one alternative that gains relevance in the future. And another one, of course, are the negotiations at the level of the UN right now on the draft terms of reference for these negotiations about the International Tax Cooperation, where they also highlighted that one of the first protocols should deal with, I think it's a taxation of cross-border services in a digital and globalized economy. So this is another forum that deals with questions that we addressed today. So maybe we also have to take into account that we will soon see another proposal that is being brought up. And yeah, despite the OECD, the unilateral, the EU perspective, we might also have to take a look at the UN developments in that respect.
Okay, thanks, Christian. So I guess we can sum up and wrap up by saying there's some pessimism on the horizon, but perhaps some optimism too. I'm afraid we don't have any time for any more questions. We have about 1 minute left. I just want to say thank you to everyone for attending. My sincere thanks to my fellow speakers for your time and efforts. I will finish up by flagging IFA's Canada future events. So in Montreal in person on February 18th and in person in Calgary on February 26th, there is the 2025 IFA Canada traveling lectureship. And then on May 27th, 28th, IFA Canada will be hosting its International Tax Conference in Toronto. So I'll wish you all a good day. And again, thank you for attending.